Hi everyone, thank you for joining us for the CFO panel. This is Every Dollar Matters, Operational Inefficiencies Are Affecting Your Returns. We'll do some quick intros real quick. My name is Gabe Harmon. I'm a managing director at Standish Management. Standish Management is a full service fund administration firm. We have 450 billion assets under administration and approximately 1,000 people worldwide right now. Greg.
And then my name is Greg Lyon, partner and CFO at Eclipse Ventures. For folks that aren't familiar, Eclipse is a $4 billion venture capital firm focused on physical world industrial technologies, so supply chain logistics, manufacturing, defense, semiconductors, and kind of everything in between. A little bit of background about myself. Started my career out in public accounting, banking and capital markets. Somehow stumbled into a role kind of out of the blue for Sequoia Capital from an old colleague I used to work with. Spent some time there, and then was lucky enough to meet Leora Susan, our GP at Eclipse, as well as Pierre Lamond, who was Don Valentine's second or third hire at Sequoia Capital to start Eclipse back in middle of 2015.
And I'm Andrew Galvin. I'm the CFO and Chief Compliance Officer for Propel VC. We invest in a few different verticals, but mainly fintech, insurtech, some cryptocurrency, and also AI. And Gabe and I used to work together at Standish.
Yeah. All right. Thanks, guys. Mm-hmm. Should we jump in?
Jump in.
Yeah. Okay. I thought a good way to start this would be to discuss kind of what the CFO role is, how you guys doing, how you guys kind of fit into the ecosystem, and particularly how you're kind of balancing the GP side and the LP side, and those dynamics.
Maybe I'll start from taking a step back, high level view. When I joined Sequoia Capital and kind of saw how the dynamics worked there, I kind of envisioned that the role was shifting and the value that CFOs were bringing was changing from, post Enron, Sarbanes-Oxley, where it was much more of the accounting-minded CFO. You hear the term like bean counter, term that I always try to stay away from used. But it was definitely much more of that in the venture capital space, where you saw public companies moving to more operational, strategic-minded CFOs, and thought that change was going to happen here in the VC world as well. And I think with just the scale and the complexity that VC has gone since I've been in this industry since 2013, 2014, it has had that shift. And so I think the shift in the VC space, as well as just a need for strategy and operations on the finance mind, has definitely shifted over the years.
Yeah, and to Greg's point, I think that depending on what type of organization we're being the CFO means different things. Also, whether or not there's a dedicated chief operating officer or compliance officer, or if there's a general counsel. So it sometimes means that you're the primary back office person who does a variety of different things for the firm. So for smaller funds, it could be a lot bigger role than some bigger shops. Being the CFO might be more siloed into just doing the accounting type work stuff.
Yeah. Well, I think it's an interesting balance too, because if we're thinking about how you're setting up operations, it would seem to me that you're setting up operations so you can support your GPs, but also trying to figure out what you're trying, what the LPs need, and get them accurate statements, timely, and all of that. So I'm kind of curious, if you broke it down between the two segments, like what's important to a GP from your standpoint, and also then what's important to an LP?
I think what's important to the GP is understanding how your portfolio is doing, the composition of it, how the funds, how much they're invested, what they're invested in, what the cycle to liquidity will be for them, and just kind of understanding their own economics and be able to report and manage the fund and portfolio effectively. Yeah. What's important for the LP is to know that the investor's doing a good job investing the money, but also getting the information you need to incorporate into your own books and records, and just kind of knowing how your investment's doing. That's how I'd divvy it up.
Yeah, maybe I'd break it down into two silos. For the GP side, you have the normal blocking and tackling, the financial reporting, the tax analysis, kind of treasury operations and management, which has become even more important this last year. To the other decisions you do for the GP is to support the decision making. That could be trend analysis, portfolio analysis, and kind of everything between on that front. And then the LPs is taking all that data you have on the GP side that you're tracking, and how do you distill that in a clear and concise manner to still give accurate, timely, and transparent reporting to your limited partners, but not overwhelm them with a ton of unnecessary data. So it's really taking that data that you have, understanding what's important to your limited partners, and then being able to share that and distill that into a much more granular distilled summary for your investors.
Yeah, that makes sense. So then as you're setting it up, if we kind of get into the nuts and bolts of it, like high level, what's working right now kind of from an operational, if you break it down by the different operating parts, right? I mean, you start with subdocs coming in, you obviously have a GL reporting system you have to deal with, you guys have cap tables. What's kind of working and not working, and even from like a tool standpoint and a software standpoint?
Yeah. And then maybe I'll take a step back again. Is if you look at what is venture capital and like what are we doing, and like the core functionality is find or start great companies, invest in those great companies, and then support those high growth companies. And like that's the core functionality of what VCs do. Well, on the back end side, there's hundreds and hundreds of different processes that have to take place, right? And so I think where this has evolved, where the old firms had hundreds of people working there to support this back end process, it's like how do we still drive that core focus and let the firm focus on that, but still take care of all these other non-core activities. And so I think there's a few ways you do that. I think there's outsourcing, fund administration, Standish, or technology, and or just process improvements internally. And what's not working well there, I think if I take those three different pillars, the outsourcing, the technology, and the internal processes, I think on the technology side, you have a lot of folks who have tried to tackle specific problems and have done a pretty good job. But none of these systems talk to each other. So you may have a system for portfolio data collection. You may have a system for valuation. You may have a system for financial reporting. You may have a system for subdocs. But they're all siloed and nothing talks to each other. And so in some point, there's points of efficiency where nothing talks and things break. Yeah. And I think on the outsourcing side, you have same type of thing where you have certain people come in here. Maybe there's a certain trend, start something, that falls out of flavor, focus on something else. And so you have, oftentimes you'll have people come in for something and then don't focus and see it through fruition to really build that product that oversees everything.
Yeah.
Yeah, and going back to individual things that you mentioned that are working or maybe not working, I think that there are some technology tools that come out, like, if your electronic subdoc processes has gotten leaps and bounds better over the last several years. I remember, getting PDFs that were filled out with written by hand and then scanned in, and it was just, brutal to read these things. So that has definitely gotten better with time. I'd say cap calls and distributions is a pretty streamlined thing now. There's a lot of technology for the mailing and to kind of wire templates if you're using the right bank and such. Stock distributions can be kind of a messy thing, getting all the information and getting that handled, but a lot of people use like an agent to help you do it. Some of the other ones were, like you talked about, is portfolio data collection. I think is one that's, it could be better because it's a fragmented industry and there's not one player that dominates the market. So there's really no network effects where some of our companies say that they're getting a template from us, they're getting a request from someone else, and they're all in different formats. So sometimes they just opt out entirely, So there's not really a great dominant player in that market that's really streamlining the collection and then also to analysis of that data. So there's definitely some players in the market who are doing it, but they're not one dominant player yet.
Yeah, interesting. I think I know the answer to this probably, but because you guys kind of said it and alluded to it, but I'm going to ask anyway. So technology is important, or how important is technology to this? Like, is it really important to solve these problems? You think? I mean, particularly if you're a growing firm, I would assume. But how important is technology?
I think it's extremely important. I think, we're the old thing was just throw people at it, right? And Excel spreadsheets. And human manpower hours was how these things were tackled in the past, has really let firms scale and focus on the core, back to what I was talking about from the early days, where you don't have GPs focusing on all these back office activities. They can quickly get to size and scale while maintaining that focus on the core, the core value driving aspects of the business very quickly. And so I think for both new firms, where those GPs are typically handling a lot of that back office in the old days, can now focus on the core investments and kind of outsource and use systems for the rest, to big firms that instead of being an HR office and managing 50, 60 finance professionals to churn some of this data using Excel spreadsheets, it's really allowed that to scale back and be a catalyst for that movement.
Yeah, I totally agree, especially for the emerging managers having these kind of turnkey solutions where they could, even create the entity, have the cap calls, have the subdoc process, have the financial reporting, sometimes done all through this same portal, just saves them a ton of time to focus on the investing and not have to worry about that stuff. And maybe as the firm grows and evolves, they might decide that there's different solutions or different technologies that would better suit them. But that's a great way to kind of get into the industry and start. Also just being more efficient, to your point, and also if you have good technology and system set up, it actually makes your review process easier because you can trust that the data integrity is there if it's been inputted the right way, whereas you don't have to re-question all the calculations and all the flows of your data, because once it's set up, you can kind of trust that it's going to behave in the same manner and it's more efficient to do so.
And I think with the technology, it's not only more efficient, but it's also more effective and more accurate. I was listening to Avlock, a podcast. He was on the drive in to the city, and I think we share a similar mind. I've always called financial reporting the no-fail mission, right? It's that area that has to be 100% accurate all the time, and it's not glamorous, and it's a lot of folks can do it, but it's something you have to get right 100% of the time. And if you're 99% accurate, it's really not accurate at all, right? I think the analogy that was made on that was, hey, if you have a bank account and the bank's 99% accurate, you're not going to be happy with it. And I think it's the same way as the LP expectations as well. Like, you can't have errors on this stuff. And so I think firms that are still using Excel, doing this stuff, the data shows that there are errors in that data. And when you're dealing with folks' money and they're not getting the distribution they should be getting back in return, technology has to be there to make sure that it actually is 100% accurate. And so really, again, is there to support that drive to being the 100% value, true source of value for all limited partners and the GP.
It's interesting to hit on that concept because if you're looking to be efficient from an accuracy standpoint, we're talking about how it impacts returns, but maybe that's not quite the way to look at it, or maybe there's not quite the correlation there. It could impact your returns, I think, if you get a little more efficient, but really the goal is to really set up operations for scalability, accuracy, if I'm hearing that right. Is that?
Yeah, I think that you do want to be efficient, and every dollar that you save is a dollar earned for the LPs. But if you're sacrificing the quality of your reporting and kind of your deliverables in order to achieve that efficiency, maybe that's not a trade-off that you want. And if you're need better capabilities with technology to meet your LPs' needs, to get them certain information in a certain format in a certain amount of time, who knows? There's only so much compromise that you should do to achieve the efficiency. Sometimes it would be better to focus on the quality of your platform, and then if you have good returns, it's probably going to be like a de minimis expense at the end of the day. So while you do want to be efficient and keep that in mind and keep your expense ratio low, making sure that your LPs' needs are met, and GPs for the matter, is also an important thing that you need to balance between the two.
I think back on the return piece. I think back to focus, right? I think firms that have that unique focus and mindset and are focusing on the activities that are driving value to their firm and their funds are going to be more successful. And it's surprising how many new managers who have meaningful sized funds that they manage, who are spending time managing the back office, valuations of the portfolio, audits, tax, and a significant amount of their time is being spent on those activities as opposed to finding, winning, and helping build those companies. And I think where the technology comes in is hey, now I can go focus on the actual things that are going to drive value for my firm, and not have to focus on the rest. And I think that shift is going to drive better returns for those people. Cost, no cost. Some things cost more than others, and some things are actually going to cost you more to be that more efficient. But it is going to drive, I think, at the end of the day, better returns for those people that can stay focused on those core activities.
And also, I think that the level of service provider that you want to work with is really specific to your company size and needs. Like if you're a small emerging manager and you have maybe a simpler fund structure, maybe you can get by with a regional firm to do your tax work and your fund admin and stuff. But if you have a higher sophistication, you have institutional LPs, you might want to engage a top tier firm like an Aduro or a Standish, and especially if you have aspirations to launch a second larger fund that you think you want to have kind of a continuity of relationship there, so you're not kind of porting things over from one system to the other. So I think it's a question that everyone has to look at for themselves based on their unique characteristics of their firm and kind of go with what makes sense for them from an efficiency standpoint.
Yeah, that's great. Well, that's perfect, because I was going to head is kind of the trajectory of a fund and when to start. But I'm going to pause for just half a minute. I forgot to mention this. I see some questions coming in. I think that's great. If we have time at the end, we're happy to kind of go through some of these questions. So yeah, please feel free to put some questions in there. So sorry, back to that. You guys, so your backgrounds are actually unique. I think, Greg, your background's interesting. You started at an established shop. It had its own process set up. Then you go over to Eclipse. Now you're kind of in a growth phase, and there's different points in time when like, hey, I need to be here at this point, but I'm really scaling to this point.
Yeah.
Yeah, and even Andrew, I'd love to hear you take too, because your background's interesting coming from the fund admin side. But yeah, Greg.
It is. I think Andrew brings up a good point. It's like, hey, find the vendors that work best for you, but also, I always kept in the mindset of like, hey, we don't want to be, our first fund that we raised was $125 million, and that's not where we wanted to be. That's where we were at a point, but it's like, hey, we have ambitions to be much bigger than that in a relatively quick period of time. So we want to have vendors, we want to have systems and platforms that can scale with us, at least in the in the next 5 to 10 year period, and not break and fall apart. And so I do think back to who you are is like, what are your ambitions, and making sure that your folks, your greater team and your greater kind of ecosystem and platforms can actually scale pretty fast. But I think, coming from Sequoia, at the time it was a very large finance team, everything done in house, some technology built in house, but very much a manual process, and then get into being able to rethink that. I was bearish on outsourcing to a fund administration at the time. Met the Standish team and was kind of blown away by that, and saw the ability for that to scale. And then back to the focus is like, hey, we can actually focus on some of the more operational, value-driving finance activities in house, outsource to fund administration, and kind of scale quickly over time. Was the right partnership for us. And so, I think we always had the view that we were going to be much larger than that first fund at that time in 2015. And so really built processes that were much more robust than you'd probably expect from a $100 million fund. Yeah. And I think that comes from your institutional LP base as well. Mm-hmm. As you scale over time, as things become more complex, as your LP base becomes more institutionalized, the expectations are going to be even greater. And so just, always keeping in mind, it's like, hey, here's where we are now, here's our expectations, but like, $4 billion from now, what's going to be the expectations being, and what kind of leaps and steps do I need to take where I can, either already get there or, get there with, another step or two up that ladder.
Yeah. Yeah, I would say that, speaking up from the experience of a fund admin and also someone who's kind of joined firms that have legacy systems already set up, when you work for a place that is a fund admin or you have a variety of different clients, there's sort of a best practice, at least for that firm, that gets developed, is like, these are the systems we like to use. Here's how we've seen the architecture of the back office and how the systems talk to each other. And once you kind of know the playbook, you can kind of come in there and know the best, most efficient way to kind of set things up. And so I've seen other clients that when they first came on at Standish or when I first joined them, that they weren't following those best practices. So there was things that were clunky, the things weren't working. There was kind of issues that needed to be cleaned up, And so I think that's what's given me a perspective, is like, there's always people who are trying to do it on their own. And it's not always the most efficient way. So having seen that and kind of having that through line where you can quickly see like, oh, this company needs to add this, I think that's kind of the perspective that I like to bring.
Yeah. I wonder if we kind of, if we got a little bit granular on this thing. If you are that $100 million fund, what kind of things would you think they should be thinking about out the gates? And then what might you say, hey, like push that to like fund 2, 3, 4, 5 down the road? Is there?
I definitely think that utilizing the technology platforms out there like AngelList or Carta or so forth, that where there's good technology where things are done electronically. The more 2023 your technology is, the better experience is going to be for the LPs.
Yeah.
But just making sure that you're getting them the numbers on time, having the process be seamless where they can do the subdoc process digitally. I think those saving them those kind of pain points is in your best interest. I think something where you could probably not spend the money is like a big four accountant, especially if you're an emerging manager.
Yeah.
They have the deepest resources from a national practice perspective. If you have an incredibly technical question that just must be answered, only they can do. But 9 times out of 10 for an emerging manager, you're not going to encounter those. So it's kind of maybe over too much firepower for the level of fund that you are, so to speak. So that would be one that I would definitely not go with, is maybe use a regional firm in Silicon Valley who they still know the space. They know what they're doing, but they're not going to be as expensive. That's probably the one area I can think of off the top of my head. That would be the.
Yeah, I think it goes back. I mean, I think every firm is different, right? From you have, certain funds that write small checks in 100 different companies to the more like higher conviction, less companies, higher ownership firms as well. And I think that will drive a lot of your processes and what you need to manage that firm and that fund. At Eclipse, we're less companies, kind of higher ownership, higher conviction, higher involvement style. From day one, it was like, how do we collect data from our companies on a real-time basis without taking any time from them, but where we can get like real data, at least on a quarterly basis. And then have that data useful in a format that's useful to how we run our internal operations. To, I think, setting up with a good fund administration partner or someone that can handle that and execute it well. Back to the no-fail mission part. To a good CRM platform to track your deal flow and kind of see that through fruition. Things that would not scale over time, compliance. I mean, there's, as you grow as a firm, the expectation for how you manage the firm, your internal operations, conflicts of interest, and kind of everything in between, that gets greater and greater. And holding everyone accountable to those takes a lot of time and takes a lot of effort on behalf of everybody. You grow into that over time, and you'll have your 250-page compliance manual. But I don't think that's something that's needed day one.
Yeah, I'd say one of the more important ones to go with is a good fund admin, because not only will they execute the no-fail mission thing that you've been talking about, but they also have just industry expertise, and there's sometimes no other way to find things out of how things are done just by talking to people who have kind of done it before. So having a kind of expert in the room who has a lot of experience can just counsel you through some things that you may not have seen it before, but they have, or they know someone who has. So they can kind of guide you, like, what's a good law firm to use? Which banking partner should I choose? Hey, have you done this type of transaction? And chances are that they know someone who can help you navigate that. So it's really like the wisdom of the crowd via working with a good fund admin that's just on top of the services that's kind of core to their platform.
And then another vendor that would always, and if you're starting your own fund, is going with a fund counsel who can set you up correctly from day one. The times where I've seen firms just have these crazy complex structures that ends up costing you for the life of that fund is folks that are going with maybe a firm or fund that doesn't have a lot of experience in the venture capital fund space. And so these crazy convoluted structures, just things that aren't relevant for venture capital space, that as you keep raising new funds can get difficult to unwind. So maybe you're setting yourself up with hurdles and some other terms that just aren't common in venture because you went with some cheaper firm or from day one. Yeah.
And to iterate on that, also just getting the right protections. Like there's certain things that you want to make sure you have certain language in there to protect you in case one of your companies does an ICO or something like that, and you didn't have the language in there that would get you a right to have to participate or something along those lines. So having someone who's kind of writing your agreement in a way that you're going to have coverage no matter what type of situation that can arise, because chances are at the time it's written, you're not contemplating what's going to happen to you in the future. But if your agreements are strong, they'll be able to navigate all of those situations because they've kind of seen it all in the Valley.
Yeah, fantastic. That's great answers. What about you guys? When do you hire a CFO? And fractional CFOs. We're seeing more and more fractional CFOs. When's a good time to start thinking about? Well, it's multifaceted. When's a good time to start thinking about a CFO? And if you're trying to look for that, what kind of criteria would you hope?
Yeah, I think when I'm advising, smaller firms that are thinking about hiring their first in-house or partial in-house CFO, I think it comes down to where are you spending your time? Is it on the valuation accounting side?
Yeah.
Is it managing your portfolio, data collection, deciphering that data into a meaningful format? And I think that will drive your need. I think there's a time when, like I said, there's a time when some of these GPs are spending a significant amount of time. I do think some of these platforms, such as AngelList, are going to push that hurdle. Where when I probably started in the industry, it was much sooner that I would recommend someone hire someone in-house to manage their fund admins, to manage these internal processes, and to manage everything outside of those core activities. I think that's getting pushed out by the technology and the sophistication of these platforms and service providers.
Yeah, with the outsourced fund admin model and all the technology tools that are available, I think it's a lot easier to have much leaner back offices, and I would say that's actually become the norm, is that more people are using outsourced versus having large internal teams. For the LP perspective, they like the transparency that someone else is doing the books and records, and so there's less chance for fraud or something happening. And then from the GP side, you can obviously deduct it to the fund, so it's more cost effective for them. So it seems like the industry is largely going in that direction. And so you can have these back office architectures where there's really one internal finance person, and it doesn't have to be a CFO. It could be a VP of finance, and you get to know the person, and as the fund grows, maybe you eventually promote them. But there's also a lot of people who are doing the fractional CFO services these days, and so you could decide if that's appropriate for you. If you don't have that big of a need yet, it's not really a problem for you. You could probably save money having a junior person or using the fractional services until it's let's say you're spending $300,000 a year on your fractional CFO service. Maybe at that time you're wow, it's more efficient for us to hire this person. And not only that, we could get additional work from them, and they can do more for us than the fractional because they're kind of splitting their time amongst many clients. So I think it's kind of those things where when you need it, and but there's a lot of good options if you're not quite ready that you can use in the meantime.
Yeah, that's great. Okay, I'm gonna switch gears a little bit. Treasury. Obviously, the recent events happened with the bank. I'm curious from your guys' point of view, what's changed on the Treasury front? Has it got more complicated? Is it actually a good thing? We've implemented better practices now and reduced some risk?
Yeah, I think it is a good thing. I think there were some players in the market in the banking sector who people got a little too comfortable with, because they were so ubiquitous. But they were exposing themselves to risk that they didn't realize they were doing at the time because it was the industry standard. So I think it's the industry is in a healthier place. Living through the Silicon Valley Bank collapse was kind of a surreal moment for a lot of the CFOs in the Valley. But now that we're on the other side of it, I think that people have implemented kind of safeguard practices, like having secondary accounts that maybe you don't use that are just there for backup in case you need to quickly move money away, or they're using sweep products like ICS where you can have your money split up into chunks of $250,000 so all of the accounts that hold this have FDIC protection. I think that from my perspective, and there's different views on this, I think that that's a pretty sufficient method to secure your money as long as you're not holding vast sums of money that would be in excess of the limits that you can utilize ICS for. So we've gotten comfortable with that, still using Silicon Valley Bank, using the sweep products, but and also having these backup bank accounts where if something does happen, some black swan event, you can quickly pivot and move your money to a position of safety. The sweep products do earn yield, but it's much lower than the prevailing rates that you can get otherwise. So because of that, we've, in our management company, been buying T-bills that are held in a brokerage. And this is ultra secure because the securities are held in a segregated account with the brokerage, and they're earning about 5.5%. So as we call the management fees, take them, we're earning a good yield on that, and with the high interest rate environment until it's ultimately spent on salary, other things and such. So that's how we're using it. I'm curious if you have.
Yeah, I'm thinking about the best way to kind of frame this, but I think, it's gotten more complex. As opposed to just having accounts at the primary players of First Republic or Silicon Valley Bank. Now, for each fund, you have multiple accounts, right? At a GSIB plus a regional bank, line of credit terms have gotten quite a bit more expensive. And I don't think the dust has settled. I think there's going to be more regulatory changes. The way that some of these regional banks have historically operated is going to change. I think you may see losses in regional banks' real estate portfolios and maybe even some of their venture debt portfolios. So I don't know if we know if the dust has settled, but I do know that we're all spending a lot more time, trying to understand these risks and try to develop policies to mitigate these risks. I don't know if we're better off. I don't know if we're better off as an industry. I think we are spending a lot of time and energy, and some of these staples of the Valley that were around to support, many large companies, may not look the same as we kind of come out of this. So, I think, for us, making sure that we're putting, if we are, keeping money at regional banks, making sure that it's in products that are safe, having backup accounts, because priority number one is, yes, priority number two, some yield is important, but way beyond that is priority number one is like keeping that capital safe that you keep on hand. I think luckily for venture capital firms, historically, firms don't keep a lot of cash on hand.
That's right.
You call for capital on an as-needed basis. Typically, you're drawing on lines, throughout a quarter and then paying that off at quarter end or whatever it may be. And so you're kind of negative throughout a quarter, and then you call for capital, have it on hand for a couple of days as you pay off your line of credit. And so the risk is relatively low from a total capital standpoint.
That's right.
But we're spending a lot of time on it. I think, I don't think we're done. We'll see how this kind of pans out over the next few months or years.
One further point on this is I think the solution or the way things are for VCs is a lot different from portfolio companies, because some of them are sitting on a lot of huge amounts of money, especially if they just did a recent round, So I think for them, it was a lot more necessary to put that into a GSIB or to ladder them with T-bills or other things that were more secure than just leaving it in a checking account somewhere. So there is a difference to be drawn there. And also, the problem is that when we were exploring moving money or opening accounts with GSIBs, at least at the time when the SVB collapse happened, they just really weren't ready to capture the venture capital market. They didn't understand the services and kind of the bells and whistles and things that we needed, like wire templates or just no wire fees when you're sending wires and stuff. So the Silicon Valley Bank and FRB really understood the industry better, and so it was going to be a big loss if one of those two went away. And luckily now we're in a spot where the GSIBs, some of them are trying to gain market share and kind of appeal more to the VC market, and also those two banks are still around, be it post acquisition, but they're still servicing and understand this industry very well. So
yeah, makes sense. What about interest rates? Are interest rates impacting how you guys manage cash a little bit?
Yeah, I think we utilize our lines of credit less than we did when it was essentially free for that period of time. And so we're definitely much more cognizant of like when we're on lines and how much that is costing the funds in real dollars, but still utilizing them. But I think even outside of interest rates, the cost of just lines of credit for venture firms and funds has increased as a result of the banking collapse.
Yeah, we're definitely trying to capture more of that yield, but it really depends on your LP base. If some people are sensitive to like an ECI or UBTI, so if you're earning a lot of interest, it might be income that your LPs can't receive depending on their characteristics. So some people are able to generate that yield and actually make money off the cash balances, where other firms can't really touch that because they don't want that bad income to flow to their LPs.
Yeah, makes sense. Okay. Again, kind of switching gears a little bit, and this has been talked about a lot lately the pandemic, we kind of hit it hard, but I'm curious, are you guys seeing, are you coming back in the office, and is that helping?
Yeah, I think for us, we didn't leave for all that long. We noticed relatively early that we work better as a firm at least a few days a week. And just those conversations that happen in the office, being there, the culture, everything's improved if we're together a handful of days a week. So we went back a couple months in the pandemic, and then we're kind of full time. It's been I think 2 years now or whatever it's been, a year and a half, 2 years. And yes, some hybrid. I think we've also acknowledged that 5 days a week that was kind of the historical norm. May not be the best for people's work-life balance either. And so, we've kind of worked through a hybrid where everyone's in the office 2 to 3 days a week. Mondays, everyone's there, and then kind of, throughout the week, it's flexible for the rest of the folks. And then every other month, getting together as an entire firm for on-site weeks and fly out our New York office, fly out, people that are working remote to meet at our Palo Alto location to spend that week together as well.
Yeah, that's great. What do you?
Yeah, we were remote during the pandemic, and as you said, there's a lot of great work-life balance. If you want to, work out, you don't have to commute. There's a lot of benefits to it, and I think that a lot of people enjoy that. But we were noticing, especially at the more junior level for analysts or people who, maybe went to college in a different town and you're their first job, they just weren't developing and building camaraderie at the same level. And it's some asynchronous collaboration where you just want to bend someone's ear for 5 minutes in passing, and that unlocks you to keep working on something. Where in a remote environment, if they're back to back to back in meetings, it's going to hold you back if you can't just quickly ask them something and collaborate. So we recently went back to an office in San Francisco, and we're trying to strike the balance of how much office and how do your practices change in this kind of hybrid environment. I think this is something that everyone's kind of grappling with right now. But I think the message is loud and clear that for us at least, there is some element that needs to be in person to truly be efficient and to grow at the rate we want to.
Yeah, makes sense. We talk a lot about the funds. I think a lot of the energy and focus tends to be on the fund side. I was hoping we could touch on the management company just real quick. I mean, if you're a GP, the management company is important. That's where the operations. What kind of things should you think about there? I mean, it shouldn't really be a side project. It is actually something you probably want to focus on and pay attention to.
Yeah, I think that this is, going back to one of the earlier points, this is something where you don't need kind of a high power admin type firm. It's a little bit easier, the accounting for it.
Yeah.
So you can use just kind of like a regular bookkeeper, and this is a little more transferable skill set that like a regular CPA could do this work for you. It's definitely important to get it right because money that's left over in the management company is the property of the GPs who own it, So it's a very sensitive and they care a lot about getting it right because it's ultimately impacting their pocketbook, So it's definitely an important thing, but I wouldn't say it has the same level of complexity for the most, at least in my perspective, than the funds or GP entities do.
Yeah, I mean, for most firms, your management fee, your revenue to run your firm is a known amount, and it's known for 10 years of the fund life. And so from a top line, it's a pretty easy business to run, right? You have a known set of revenue, and then you can kind of how do I want to go spend that and allocate that capital? And so yes, it's a relatively straightforward business. Where I think it gets more complex is how do we want to structure our firm? Back to alignment of interest, who gets carried interest in these funds? And how are you structuring this from a management standpoint to incentivize people to perform their best for that firm? I think that's where probably the more nuance and kind of strategy comes into it. But on the pure just accounting side, it's one of the easiest businesses to run. Known revenue for at least a 10-year period, and then how do you want to go spend that money?
Yeah, makes sense. Okay, cool. Well, we're coming up on time here. I thought I might take a quick look at questions. We touched on this first one here, but there's another component to it. It's on the CFO, so when is a good time to hire a CFO? But there's also best practices. So if they're out there looking for a CFO, what's kind of the best practices in trying to, where do you find a good CFO? What's the interview process? Maybe incentivizing, how do you structure it in a way to kind of onboard somebody who's pretty good?
Yeah, I've had really good experience using recruiters in the space they have a lot of connections and they can help you identify a candidate who fits your profile well. Maybe when they were working in an accounting firm, they worked in a certain department there that's directly relevant to your fund strategy and attributes, So kind of matching the experience with the needs of your fund. That's really important, and it can also just liking the person. If you're hiring a CFO, chances are you're going to be working with that person for a while. Mm-hmm. So just making sure that they're a good culture fit and you like the person, because you'll probably be working with them for quite some time.
Yeah, culture fit. I've seen successful people come out of almost everywhere. I think hire someone that you think is smart and capable at doing whatever you need. But I think it goes back to the role of there are kind of pure CFOs who focus purely on the financial accounting side, where you have folks that also focus on compliance, HR, IT, legal docs, negotiating an LPA and the deal docs with companies, and kind of involved in all that stuff. I'll say if you have someone you want to have that hat and kind of cover a lot of stuff, probably someone that comes from industry and has some background doing that stuff. If it's just the finance side, you can hire someone from a public accounting firm. You can hire someone from industry. There's a lot of different, that opens up the spectrum. So I think it depends, but I think priority number one is someone that you want to work with if you're building your firm that you think is smart, hungry, and capable to go figure this stuff out, because none of it's rocket science.
Yeah, that's great. That's great. All right. There's one on compliance. So as you guys think about data security and how that kind of fits into the compliance, what are you guys seeing there?
Yeah, so we, in my current role and my previous job as well, both used Google Suite and Macs, and that's pretty atypical, at least historically has been for finance departments. So there's kind of a switch for me going from like a PC Outlook type environment to that, but the outlook on that would be Google's data security is best in class, and so if you're using their products and they're configured the right way, it's very difficult to hack Google's servers. So just kind of relying on them to take care of a lot of the data security on that end, and then making sure that your staff is properly trained with, the phishing, how to, be out, because we get tons of emails saying like, hey, I'd like to change my banking details on a daily basis, that you just need to know what you're looking for and have good processes especially for change in contact information or wire instruction, to make sure that you're not being human engineered to do something that you shouldn't, So that we don't really have too many problems with getting viruses on the Mac. So it does kind of simplify the IT structure for us from what I've seen historically, but
I think it's changed a lot, and the risk has increased significantly since I've been in the industry. And so, it's really gone from, we've always outsourced IT. We with a group of vendors who specialize in venture capital, understand the risk, understand the kind of white glove service, understand the processes, and really help kind of build processes around that. But it's changed a lot, and so even like last year, we hired another company to come in and just to kick the tires on not only us, but all of our key vendors where data stored to check on these controls and processes and software to make sure that there aren't gaps there. And I think that's going to continue to increase in the need for that type. And I think that's typically been reserved for larger funds. And I think the expectation for LP is to start having a third party come and like almost audit your IT infrastructure is getting pushed back significantly. And so I'm hearing of funds, in the hundreds of millions of dollars range, be forced to have that, kind of process ingrained into how they're running their back office. And then, on the wire side, I think every week I hear someone releasing a wire to an unknown, to someone who hacked into someone else's email chain, and so that's also increasing significantly.
Yeah.
So thinking about processes and software and controls to make sure that doesn't happen is going to become more and more important as well.
Yeah. Good answers. Another question popped up. It circles back to the CFO one. Carried interest. It's pretty common to offer a CFO carried interest. Would that be
correct?
Yeah.
Correct.
Some firms go well beyond that, where every employee has some form of carry economics,
Yeah.
I'd say CFOs absolutely should participate in the fund. And it kind of aligns interests as well.
Yeah.
Yeah, I think if I recall the data, it's like 95% of firms, CFOs have carried interest. I think it goes back to like, how do you want to run your firm? And I think it goes back to alignment of interest. It's like carried interest is one of the best alignment tools that you can have. And so we've always structured Eclipses where everyone at the firm, from the lowest employee to Lior, who's our GP, has carried interest in the fund, so that they're all working to strive for that additional value. I'm not a fan of deal by deal carry. I've seen it create bifurcations in teams and follow-on capital and everything else. And so I'm always the advocate of the kind of everyone gets carried in the fund. If a growth team member in an early stage fund and vice versa, so that we're all one team working towards maximizing returns for that fund, as opposed to pulling a fund's only X amount of capital. If you pull some in there, it's like the bed sheet analogy, right?
Yeah.
Someone else is going to be left more vulnerable. So really working together to maximize and use all resources, all capital with a single mindset, I think is the best way to operate. any firm of any size or structure.
And if you're concerned about giving someone carry too early, let's say you just hired them and you don't know if they're a long-term fit or something, you can just the industry standard thing is to put vesting on there. And so sometimes you can be more aggressive with the cliff. So let's say you hire someone and they leave after a year. If you have it structured in a way where they don't vest in any shares, it's like they didn't get carry, but if they stay for the long term, they vest into the carry. So I think it's a good way to kind of protect against like a mistake in hiring, but still give them that upside and the alignment of interest that we talked about.
Yeah, perfect. Yeah. Great. Well, that's it. We're at time. So, yeah, thanks you guys. Really appreciate your guys' time and your thoughts here. Thanks everyone for joining us. Yeah, hope you guys enjoy the rest of the conference.